Namaste. So, in the module 1, we discussed about what is called as financial management. What are the important decisions which a manager has to take? Then, what do you mean by wealth maximization concept? We identified that every decision taken by a manager is very important in terms of finance. Now, the 3 important decisions called financial decisions we are going to discuss in this class now. Now, the first decision is investment decision. Now, the first and foremost one which the manager has to decide is about the projects in which the funds of the business have to be invested. There will be many proposals before him. He has to carefully evaluate the relative merits and limitations of each of the project. Why is it so important? Please remember, investment decision is very crucial because number 1, it involves huge capital outlay. Number 2, high risk is involved. Number 3, the decision taken once cannot be reverted at all. And number 4, the implication of it will be felt over a very long period of time. So due to these reasons, the project should be very carefully chosen by the finance manager. Now, there are 2 types of decisions to be taken, namely capital budgeting decision, which talks about fixed capital management, and working capital management talks about day-to-day activities of business, the funds required for day-to-day activities. So, all together is called as investment decision. So, long-term investment decision is called as fixed capital investment or fixed capital decision or capital budgeting decision. And the funds which are required for day-to-day activities, the management of that is called as working capital management. Now, both the decisions have to be taken very carefully because the funds which are required for long-term purposes should be raised with appropriate sources and should be put into use only for long-term purposes. Funds raised by issue of shares or debentures, which are long-term sources, cannot be used for meeting of day-to-day expenses like salaries, wages, raw material costs or advertisement expenses, etc. Similarly, the funds which are allocated for working capital purposes, namely the day-to-day expenses to meet out, these cannot be used for acquiring a fixed asset. And if that situation happens, the problem is the manager will not be able to have proper funds for either of the purposes. So therefore, the manager has to carefully allocate funds for fixed capital purposes as well as for working capital purposes. Now, before choosing a particular project, the factors to be taken into consideration will be the 3. Number 1, the cash flows of the project. Now, in any project, considerable cash flows will be there. Cash inflows and cash outflows. How much of cash will be paid, will be used in the project, and how much of returns will be there. During the entire course, what will be the inflow and what will be the outflow should be very carefully decided. If the outflows are going to be more and the inflows are going to be less, then the manager has to definitely reconsider the particular project. Should he go for that when outflows are going to exceed the inflows? Of course, in the initial stages, it will exceed, no doubt at all. During the gestation period, outflows will be more and inflows will be less. But that cannot become a regular phenomenon. So, he has to carefully choose a project. The second one, what is the investment criteria? The investment criteria is for long-term purposes or for short-term purposes. How frequently the returns are expected, right? How fast the profits are going to be generated. Now that has to be taken into consideration. And the last factor is what is the expected rate of return. Right? If there are 2 proposals, project A and project B. Project A in a span of 5 years is expected to give a return on investment of say 10% per annum. Whereas project B for the same duration is likely to give 15% per annum given the same situation. Same criteria, same input, everything remains to be the same. But project B is likely to provide higher return on investment than project A. Obviously, the manager has to choose project B in place of project A. I repeat, what do you mean by investment decision? So, the three decisions to be taken by a manager in his position as a finance manager are called as financial decisions. Financial decisions are classified into three: investment decision, financing decision, and dividend decisions. Investment decisions can be classified into short-term investment decision and long-term investment decision. Long-term investment decision is otherwise called as fixed capital management or capital budgeting decision, while day-to-day expenses management is called as working capital management. Now, the manager has to carefully choose the projects in such a way that he is able to allocate funds appropriately. Funds meant for fixed capital purposes should be used only for fixed capital purposes, and the funds meant for day-to-day expenses should be used only for day-to-day expenses. So, he has to take it very carefully. Out of the two, fixed capital decision or capital budgeting decision is considered to be very important because it involves huge capital outlay, it involves high risk. The impact of it will be felt over a very long period of time, and the decision once taken cannot be reverted at all. So, due to these factors, projects should be very, very carefully chosen. Now, while deciding about the project in which the funds have to be invested, the manager has to take into consideration the three factors, namely cash flows of the project, what is the expected inflows and outflows of the project. He has to ensure that the inflows are relatively more than the outflows. Then the project can be considered to be viable in the long run. The second one is investment criteria. What is the criteria of investment? Is it going to be for short-term profit maximization, or is it to benefit the organization over a longer period of time? And what is the expected rate of return? Are they expecting a higher return on investment or a moderate return on investment? However, if there are 2-3 proposals, the proposal which is likely to give higher return on investment or highest return on investment should be considered before deciding about other projects. Now, the projects are decided. Now, the second criteria is to go for financing propositions. Now, we shall be discussing about financing decision. Please don't get confused between financial decision and financing decision. Financial decisions are the three. In that, financing decision is one part of it. Now, financing decision is concerned with decision regarding the composition of long-term securities to be raised for investing in the projects. Now, once a project is chosen, the manager has to carefully evaluate the different sources of finance available for investment in the projects. He has shares, he has debentures, he has borrowed capital, he has term loans, he has mortgage loans, everything. Now, he has to identify the relative merits and limitations of each of the sources of finance and then go for an ideal combination. Please remember, not one single source can be considered to be fully foolproof. Every source has its own merits and limitations. Now, he has to carefully evaluate the relative merits and limitations and arrive at an ideal capital structure. The ideal capital structure should be such that the return on investment to the equity shareholders become maximum. Now, while deciding about the financing propositions, the manager has to take into consideration certain factors. What are the factors to be taken into consideration? First one is cost. Cost talks about cost of capital, which means the rate of return on investment. What is the return payable on such a source? He should take into consideration. If the prevailing interest rate in the market for the borrowed funds is nominal or low, he can as well prefer to employ more of borrowed capital and less of equity. But if the prevailing trend is showing an increase in the rate of interest for the borrowed capital, it is safe to invest equity than debt. The second one, flotation cost. Raising money by the issue of borrowed capital, say in the form of debentures or term loans or mortgage loans, do not involve much of flotation cost. because the investors are very sure that they will get back their principal amount and the interest component as and when they fall due. So they are not impressed by the window dressing or the artificial coloring of the financial picture given by the company. They are very safe. So they are not influenced by all these things. So a company which is proposing to raise money by the issue of debentures or term loans need not spend any money in going in for brokerage or underwriting commission or printing of prospectus, etc. But on the other hand, if the company wants to raise money by the issue of equity shares, lot of understanding should be done between the brokers, commission agents, underwriters, everybody, which means the flotation cost will increase. If the company is financially sound enough to spend more money on flotation cost, the company can consider employing more of equity and less of debt. On the other hand, the company doesn't want to spend much. In that case, the company can as well go for borrowed capital. The next one is fixed operating cost. Fixed operating cost talks about rent, salaries, administrative expenses, selling and distribution expenses, etc., which remain to be the same irrespective of the volume of production. Which means whether the factory is running or not, salary of the administrative staff, salary, rent of the factory, office premises, insurance of the office premises will all to be paid irrespective of the volume of operations. So that being the case, they are called as fixed operating cost. Irrespective of revenue from operation, these expenses have to be met. If these expenses are under control in comparison with the revenue from operations, then the company can consider employing fixed cost sources, namely borrowed capital. That means after meeting out these fixed operating costs, the company will have sufficient money to meet out fixed financial cost also. But on the other hand, if the financial situation is not satisfactory, that the company may not have adequate funds to meet out the financial cost, it's safe to invest only in equities, safe to raise only equity shares than to go for debentures and term loans. The next one is cash flow position. If the company's cash flows are showing a stable inflow, the sales is good, the sales is on an increasing trend, company's cash flow position is very satisfactory, the company will be able to meet out its fixed obligations as and when they fall due. In which case the company can confidently employ more of debt and less of equity. But if the sales turnover is not satisfactory, it is highly fluctuating. Company cannot rely upon the sales at all. It is safe to raise money only by the issue of equity shares because equity shareholders need not be given dividend or to be repaid the principal amount. There is no financial risk on the part of the company by employing more of equity. The next is control consideration, the preference of the existing equity shares, existing equity shareholders. If the existing equity shareholders do not mind the dilution of control, what we call as watering the equity. Watering the equity means dilution of control. When the company goes for additional issue of shares, more number of equity shareholders are going to join the management, by which decisions will be taken on a very slow pace and dividend also will get distributed among many shareholders, by which what happens, the control becomes very less and dividend amount also becomes very less. So, if the existing shareholders do not prefer to have dilution of control, the company should consider issuing more of debentures. Therefore, the control will be vested only with the existing shareholders, but the company will have more funds to meet out. The last one is state of capital market. What is the prevailing capital market consideration? Now, if the prevailing capital market shows an inflationary trend, which means there are many adventurous investors who are prepared to invest money in equity shares, in which case the company can confidently go for employing more of equity. But the prevailing capital market is showing a depression or a recession where the investors are very cautious in choosing their investment profile. They will not prefer to invest money in equity shares because they know pretty well that they may not get back the principal amount also. So they would prefer to invest money only in debentures. So that factor also should be taken into consideration. Please remember, not one factor can be considered in isolation. It's a combination of many factors which the finance manager has to take. Then only he can choose about the ideal composition of funds to be employed in the projects. Fine. So to sum up, financing decision is a decision regarding the composition of long-term securities to be raised for funding the projects in which the funds have to be employed. For funding the projects. Fine. The various sources which are available to the manager will be from owners as well as from creditors. Now he has to evaluate very carefully the relative merits and limitations of each of the proposal, then choose an ideal combination. Now while finalizing the combination of sources, he will have to take into consideration the cost of capital, how much of return on investment will be payable to the equity shareholders as well as for the lenders. Then about the flotation cost, how much money will be spent in raising the funds in the form of printing of prospectus or brokers commission, underwriting commission, etc. He has to take into consideration the cash flows, if the cash position is satisfactory in the business or not. Then he has to take into consideration the fixed operating cost. If the company's other expenses or the regular expenses are stable or well under control, then the company can employ more of fixed cost sources. Then the company will have to take, the manager will have to take into consideration the control factors also, the preference of the existing equity shareholders. If the existing equity shareholders do not mind dilution of control, the company can go for a further investment in equity shares. Whereas, if the existing shareholders do not want any control to be diluted, the company should go for raising money by the issue of debentures. And what is the prevailing state of capital market? Now, the capital market trends will change, inflationary situation or the recession situation or a depression where the prices are falling, share prices are falling. If the capital market is showing an inflationary trend, more investors will be willing to invest money in equity shares. So the company can easily raise money by the issue of equity shares. But if the capital market condition is showing a recession trend or a fall in prices, it is safe to raise money only by the issue of debentures or going for term loans, because investors will be very cautious. Fine. Now going to the next one is dividend decision.
Capital market வரைக்கும் முடிச்சீங்க. முடிச்சிட்டு இப்போ நீங்க சொல்லிடுங்க capital market முடிச்சிட்டு next we will see
dividend
in the next module or whatever.
சரி, ஒரு நிமிஷம். இப்போ வந்து டிவிடெண்ட் டெசிஷனோட இன்னொரு டாபிக்கை நான் கண்டினியூ பண்ணிக்கலாமா?
அது அலௌடுனா ஓகே.
25 minutes ஒரு இது.
இப்போ வந்து as such வந்து 20 minutes வந்துருது. சரி. சோ இப்போ நீங்க இப்போ இது
முடிக்க முடியாது.
இப்போ அது கஷ்டம். சோ நீங்க ஸ்டேட் ஆஃப் கேபிட்டல் மார்க்கெட் முடிச்சிருக்கீங்க.
ஆமா.
We will next see about dividend and
financial planning.
So முடிக்கணும். Continue.
So, state of capital market. So, we discussed about the capital market consideration, about inflationary or recession situation. Now, in the next class, we shall be discussing about dividend decision and financial planning. Fine? Namaste. We now start with dividend decision. Now, in the previous class,
division என்ன முடிச்சிருக்கீங்கன்றத பார்த்தேன். I will close it. This is module what, man?
This is module 2, sir. உங்களை மாதிரி தான் இன்னைக்கு நானும் பதில் சொல்றேன். So we discussed about the capital market consideration, about inflationary or recession situation. Now in the next class, we shall be discussing about dividend decision and financial planning. Fine? Namaste.
The fine.